Japan, China, and also we like Japan, which is linked to growth in the region, but always has a certain global growth linkage. It does have incremental catalysts via the BOJ policies. So we've been very focused on non-US markets to kind of add cyclical risk tactically. There's a bit of a setback on some of those trades because, you know, you have a bit of a kind of moderation of the narrative and obviously risk appetite. That could actually create a good opportunity to revisit those into that better momentum at this juncture.
Christian, thank you. Really fascinating stuff. You said a lot there in the last 10 minutes. Christian Müller-Glissman there of Goldman Sachs. So much to discuss. So last year, the big problem was this volatility around trying to price the so-called risk-free rate. And we thought after we closed out 2022, we'd come into 23, we'd dealt with that story and move on. Because if you can't price the risk-free rate, how do you price risk? Then all of a sudden, month of February, we're doing that game all over again. I'm not sure where to start with Christian there. I keep hearing more and more from people, the international story, Japan, China, Europe. Look at these moves in Europe. The bank's up by 22%. It's pretty phenomenal year to date.
This is really the issue. Do you still lean into risk at a time when the economy keeps outperforming? To me, one of the big takeaways was this question of duration risk versus credit risk. Are you looking at ongoing concern about duration with the rate volatility that you talked about last year, causing perhaps a greater amount of inflation getting priced into the system? Or do you lean into this idea that we have a good economy? Do you go into what's working because it continues to work regardless of what people think should happen?
I mentioned Johnson & Johnson and whatever their new name is for Band-Aids and Listerine and Aveeno, but that was a feeding frenzy yesterday for quality bonds and particularly out long duration. Long ago and far away, one of the magic moments, John, of my ute was I had a meeting with John Templeton. It was set up.
That's very cool.
Very, very cool. I won't go into it right now, but I will never forget the gentleman from Tennessee telling me there will be a shortage of bonds. I don't understand the dynamics of the shortage of bonds as rates move up because we've never seen where we are right now.
Torsten Slok of Apollo just put out their report over at Apollo on credit markets. Here's a stat for you. 15% of high-yield bonds trade with a yield higher than 10%. 15%. I mean, high yield's kind of like high yield now for the first time in quite a while.
The question is, does it deserve to be, and should it be traded even with higher yields based on the rate regime we're in?
I go back to Oksana Aronoff at JP Morgan Asset Management yesterday. She's just not ready to buy it here. She thinks you'll get opportunities this year, just not now. Just wait.
She's waiting on high yield.
She's waiting. Be patient. That's her message. Futures right now down about 0.25% on the S&P. Up later in the next hour, so in about 48 minutes from now, we'll speak to Andrew Sheeds from Morgan Stanley.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power of the Supreme Court. There may be demonstrations in about 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. The only Goldman Sachs banker tied and convicted in the global 1MDB scandal is sentenced today in New York. Roger Ung says he suffers from a substantial mental health condition and shouldn't receive the 15-year term that prosecutors want. The government says Ung was a key figure in the conspiracy to loot the Malaysian fund of billions of dollars. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 point. Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations?
In the houses we should have in 2022, largely because of Trump. Our voters more or less know this. So I think the fact that we want to win, we know we need to nominate somebody not named Trump, and if we do, I think we'll win the White House.
Well, the party's moved on since that guy was in power. Paul Ryan there, the former U.S. House of Representatives Speaker from a number of years ago, Tom, from New York City this morning. Good morning. The conversation that he had when he was in that house, Tom, it looks like we're going to be having those conversations again a little bit later this year.
And is it going to be tinged with Ryan GOP tone or Trumpian GOP tone? That's a huge challenge, not only for the Speaker of the House, but for the Republicans in the Senate as well.
They weren't just the Trump tax cuts, were they? They were the Ryan tax cuts that he'd wanted for a long, long time.
Yeah, and maybe to the defense of President Trump, they were everybody else wanted him tax cuts as well. I mean, I'm not sure how loud the call for tax increases is right now.
Is this what the president's doing today? It's the final effort, the final push to try and campaign on a reversal of the Trump tax cuts?
Brammo, give me an answer. I don't have one.
There are a number of provisions that are just direct reversals, including increasing the corporate tax rate to 39%. It's just basically rolling back some of what we saw. There are, though, these other aspects that did not get passed, including the carried interest provision and some of these other corporate tax breaks that, reinvestment risk with real estate that have been on the table but never fully passed.
They couldn't get it done.
Exactly. And I think that tells you a lot. It also shows how hard it is to reverse something that's really popular among a lot of people.
Huge focus for us the next 40 days, and fiscal will be front and center in our trip to Washington for the meetings of the International Monetary Fund. She is in Washington, Anne-Marie Horton, our Bloomberg budget correspondent. Anne-Marie, I looked at Japan, which is what we don't want to do. The numbers in Japan I thought were misreported overnight, looking at nominal and real GDP. Bloomberg did a great job on that. The real GDP statistics in Japan were shocking with somewhat elevated inflation, but this didn't work out like Kuroda wanted it. And the simple answer is the survey number on real GDP in Japan came in elevated, and the actual number that we got was way below it. That's the CBO's worst nightmare. The CBO leads with nominal GDP, Anne-Marie, and they just say there are challenges out front. Tell me about how Congress will model this with the present politics.
Well, the challenges out front, I think, were on full display the last 48 hours, right? When Jay Powell, the Fed chair, was testifying in front of the Senate Banking Committee as well as in front of House lawmakers, and all the economic issues and the politics at play, the questions were there. It's about higher inflation. It's the concerns about what does this mean to have a rate-rising regime, and what does that mean for the unemployment rate going to 2024 when some of these lawmakers are up for re-election? They do not want to see a recession. That tense moment between Senator Warren and Jay Powell put on display exactly what is happening in the American economy. It also, there was a subtext to that which really highlighted what many in the Democratic Party view inflation different from the Republicans. Republicans say this is excessive fiscal spending from the Biden administration, and many in the Democratic Party say you have to look at the rest of the world. There's higher inflation in Europe, there's higher inflation in Asia, and there are things that the Fed can just not control, like Russia's invasion of Ukraine, supply chain kinks, etc. This is the tension that is playing into the politics.
Do any of the politicians understand the linkage of the higher interest rates their constituents are enjoying and how it plays over to the budget? I'm looking at a chart in the 16 charts, page 10, that the CBO published in the last 48 hours, I believe. Do they understand that that chart is move to a higher interest rate regime?
I'm sorry, I have not seen page 10 of the CBO report, but what politicians are concerned about with higher interest rates is higher mortgage rates. And this was brought up by a number of senators and congressmen and women on both sides of the aisle. They are concerned that it is becoming...
Yeah, of course she does.
It is becoming much harder. It is becoming much harder to afford a mortgage in America. And to John's point the other day, it's also much harder to just buy a home outright, right? You know, you're looking at what one senator said, he got a hell of a deal when he thought it was when interest rates are 10% in the late 90s. But to John's point, the house was probably much more cheaper.
It's the boomers, Anne-Marie. The epicenter of the problems.
Oh, man, it's not trying to create problems.
Just, it's not. AMH, that was a tremendous comeback, and I wish we had a shot of Tom there. It's just like, what do you mean you haven't read page 10?
They're not laughing.
No, I'm sorry. It's all in English, and it's all clear. And what's changed is the interest rate regime.
Can I pick up on these proposals from the president? AMH, we often talk about the division, perhaps, between what Washington, D.C. would like to do and can do and what the rest of the country would like. Just how popular are some of these proposals that the president is offering, whether they see the light of the day or not, whether they are dead on arrival or not? How popular are they?
They are popular. Higher taxes on corporations and the very, very wealthy of American are popular. This polls well. This is also why the president, even though he knows this has no shot at getting through Congress, is going to have almost campaign event. This is a budget unveiling, and he's taking it on the road to a swing state. He's going to Philadelphia. And why? Because this is going to land well with the public. So this really isn't about a budget. This is about where the future of, one, his campaign may go when he decides to run for re-election for 2024, and two, the future of the Democratic Party and how they want to differentiate themselves from the right.
Just quickly, Anne-Marie, since the rate picture is so important to all of these debt discussions, how likely is it that Janice Eberly, the Northwestern University professor, who is the likely pick, that's at least what's being reported, to succeed Lael Brainerd on the Federal Reserve, how likely is it that she could be put into that post, nominated and confirmed in the very near future?
Well, first, she is the likely candidate at this moment. She's had a number of interviews in the White House with key players like Lael Brainerd, the new NEC director, and of course that's the job she'll be taking, Treasury Secretary Janet Yellen, from what we know, but she has not sat down with the president. So until she sits down with the president, we don't know if this is a done deal. The issue the Democratic Party has right now with this candidate is that, and this was also on full display the last 24 hours, there is a number of lawmakers that are really pressing the Biden administration to pick a Latino economist for this job. They say that there's never been a Latino on the Fed board, and this is an opportunity for them to have this moment. And 34 lawmakers signed up with Senator Menendez's letter to the administration, and then a number of them used their time with Fed Chair Jay Powell to reiterate this concern. So this is potentially a roadblock for the Biden administration with this potential frontrunner.
I'm going to ask a question, Anne-Marie, and I'd love your insight on it, maybe even just your thoughts if you haven't even got any conclusions. But I just wonder how seriously this administration takes the Federal Reserve. And the reason I ask that is because we were all waiting to see who would be the Fed chair. Do you remember that Thanksgiving a couple of years ago? They dragged their feet on that. They drag their feet now. And I think it's interesting that they needed a new NEC director, and they just said, yes, sure, Fed vice chair. It's not like anything important is going on at the Federal Reserve right now. We'll take the number 2, and then we'll figure it out. I get why we take it so seriously, because it's a big feature of what we cover every day. Is it that important to them?
I think it is important to them. I think there's two issues at play. One is that this isn't just about picking someone they think is going to do a good job and that they have faith in at the Fed. It's also shoring up the votes in a Senate where they have a very slim majority. So if you have senators that are now saying this needs to be a Latino pick, that is going to make it much more difficult for them to then go back and decide who can get those votes, right? This is Senate confirmation, and that's really part of the problem.
MH, thank you. Down in Washington, important perspective on things. I think there is a suggestion at times that, based on the way they've acted around some of their picks, Tom, that they, it's just not that high up on the list of priorities.
She was talking there. I was reading page 11.
I still, I know it's ages ago, but what took so long to renominate Powell? I still don't get it.
People think that it was one reason they didn't raise rates soon enough, and that it ended up being a policy error.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equity futures a bit softer this morning. Good morning to you. Thursday morning, no Chairman Powell. We've had 2 days of that. sure you're full of it and don't want any more. Futures down about 0.25% on the S&P. On the Nasdaq, we're down about 0.5%. Yields still in at around 5% at the front end on a 2-year. Yields higher for 3 straight sessions on the 2-year yield. We're down about 2 basis points this morning off the back of that 3-day streak. Down to about 5.05% on a 2-year. On a 10-year, still sub 4%, but pretty much there, 399.73 on a 10-year. The difference between the 2 and the 10-year getting tons of attention yesterday after a strong ADP report that you tell us every single week, every month, doesn't matter, and then you trade on it. 2's 10s dropped to below negative 110 basis points. They're now back to about negative 105, the difference between the 2. And just to round it out, Tom, in foreign exchange, it's not just the hawks out of the Federal Reserve this week. It's over in Europe too. The ECB talking up 50 basis point moves. We had Holzman of Austria saying maybe four meetings in a row. I think the Italian central bank governor came out this morning and said, I don't appreciate people coming out and talking about upcoming meetings. So that was the pushback.
I like the idea that we're now at a point, and there's been a number of people that have written this up this weekend past, where it's now the level of where interest rates are creating a real tension and a nuanced tension here, there, and everywhere. The street loves to look at spreads. The street loves to look at dynamics, the first and second derivatives. The public just looks at the level. I haven't looked at the 30-year mortgage this morning, but it's above 7%. That's the only level that matters, is one example.
In and around that level, yeah. And we're trying to work out still at the Federal Reserve, Lisa, if we are, quote, sufficiently restrictive.
Can you imagine if Fed officials came out and said, you know, I don't appreciate what Neil Kashkari said. The fact that he came out with some more guidance.
That would make it a lot better, wouldn't it?
He basically saying, we agreed to be forward, have no forward guidance. Well, that's forward guidance. I think it would make it more interesting.
What did Christian Horner called Formula One? Kardashians on wheels. What would they call that at the Fed?
Kardashians at the Federal Reserve. Can you imagine?
Important, yesterday, the 30-year bank rate mortgage out to a new recent high, 7.13%. Amazing. I did not know that.
Amazing.
All right, let's take a look at some of the stocks that are moving today. Let's talk about Silvergate. Silvergate's not having a great day after coming out and saying that they want to have an orderly wind down of bank operations and a voluntary liquidation of the bank because that is, quote, the best path forward. Basically, they're also saying that the wind down and liquidation plan does include full repayment on all deposits. Shares are now lower by 51%. The concern here is what other shoes are there to drop within the crypto industry fallout? This had become a bank that really bet the bank literally on crypto and is suffering the consequences from it. We'll talk about that more coming up. It is spin-off Thursday. I want to just make a point that we've been seeing more of these spin-offs and breakups. Spin-off Thursday. GE is expecting its profit margins to widen at its aviation division after spinning off that particular jet engine unit. So this is going to be interesting. And those shares are up by a whole 0.8%. And then Uber is exploring whether to spin off its Uber freight logistics arm in a sale or separately traded.
I didn't know they had one.
I was going to say.
Oh, that's actually been a big
delivery?
issue. No, this is actually one of their biggest, like one of the side businesses. Logistics is everything. I'm a big believer in logistics. People come there like, not plastics, logistics. I am a complete believer in it because that's how you like basically strip out the inefficiencies in shipping and supply chain disruptions. If you can understand how many drivers to get to a different place.
Right, yeah.
It's a big issue, especially because, keep going, truck drivers are, there's a huge shortage of them.
Can you just see the modern redo of The Graduate?
Why did you cut in?
With a cocktail in?
Riveting.
And she'd be like logistics.
Did you not realize it's spin-off Thursday?
I guess so. Can I point out for Mr. Culp, who came into GE and parachuted in Boston, off the gloom of 2 years ago, the stock has done a double. I just, you know, within the world's going to end for General Electric as we know it. Mr. Culp has managed a double.
Well, and is spin-off going to be the solution to the conglomeration that we saw 10 years ago? And this is sort of how it goes in cycles. Everybody get together and then, cycles turn in.
Is there a special later on Spin-Off Thursday?
There's a special on logistics, and I'm so there for it.
Awesome. Can't wait for that.
Time is urgent right now as we go to Friday.
You can tell.
It really, time is urgent. Christina Kentmany with the Senior Portfolio Manager, Global Debt at Invesco. What's the first thing you look at every morning when you look at debt on the Bloomberg? Where is your focus in that broad term?
I mean, I think you have to look at Treasury rates given how focal the Fed has been and where we are. And I think, exactly as you said, the curve has been in focus for everyone. And then FX across the board, right? FX, I think so far this year has presented the biggest opportunity, and it's moving a lot. So those are our two kind of focuses in the morning.
You're not in Camp 50. Why are you not in Camp 50?
Look, I think Powell muddied the water a bit this week, for sure, and the chances of that are higher on the table. But I think they make their, even the communication this week, and there was a little bit of backtracking yesterday, but not quite. And we obviously get payrolls tomorrow, and we get CPI next week. But to go back and justify that we step down 75, 50, 25, back up to 50, it kind of puts you in a place that you need to go 50 again in May. Again, can they do it if you have really strong data tomorrow with payrolls and CPI? Yeah. For sure. But I think if you go back to some of this Fed speak, they're clearly concerned on the inflation side and that they're not making enough progress on the labor side, and that inflation, they still have a long way to go. But I'm not sure that the noise that we've seen in the data in January justifies reacting to the February data, right? Like they've said that it's so noisy. We almost have to get to the March data to see what the real trend is and where we're going here.
So words are important. You used it twice, noise. Why do you think it is noisy?
Why is the data noisy?
Yeah, why is there not signal there?
You know, we have quickly shifted in the last 3 to 6 months from these concerns of a hard landing in the U.S. and really globally to synchronized growth globally. You had an earlier China reopening. Europe has had stronger data really coming out of Q4, both as a result of lower energy costs and then certainly a milder winter. And then you've had U.S. data accelerate, where people were talking about the end of the world is coming in Q2, right? Like,
recession, the disinflationary process has started.
Yeah, so we've shifted from this hard landing to no landing. And I think the idea of no landing is a bit optimistic, right? It's just a matter of where are we pushing out that landing to, and how strong is this recovery, and how long does it last? But I think it's very hard to look at the data and say with confidence we know where we're going. It's noisy.
Okay, so in this noise, I'd love to get you in the Chevron versus Glisman divide, because we really saw this massive gap. You've got Chevron saying last year was a year of duration risk, this year is a year of credit risk. Crispin Miller-Glisman coming out and saying that's the opposite, actually. Duration risk is still very much important, because if you look at the data, it is supporting risk assets and it's supporting growth. Where do you stand on that?
Look, I think that duration, I think last year was like a very clear, you could look at the market and say, we can be short. I don't think that there's as obvious a duration trade, but I think duration risk is very clearly important. If they do step up to 50 in March, and then you have a very higher likelihood of 50 again in May, you're talking about another 100 basis points of hikes in the next 7 weeks, and the potential that I would assume if you step up to 50 and 50 that you're going to continue going, and you're talking about a terminal Fed rate that's much higher, and another, right, we look at 2s at 5%, and that's a high level, but if you are really stepping up, then are we talking about Fed funds at 6.5 or a much higher level than what the market's been talking? Then you bring duration risk, I think, much back into the picture.
At that point, I mean, where do you fall in terms of thinking that credit risk, to the Oksana Aronov's point or to the Steve Chevron's point, really hasn't priced in this type of scenario versus, you know what, it'll hold in because a lot of companies have just termed out the maturities?
Look, I think that the struggle in credit is that when we look at corporate balance sheets still generally remain robust, and it's healthy for the medium term. And I think the problem becomes if you have a much larger step up in rates again, and where are these companies funding step up needs? And Tom, you bring up mortgage rates in the US, and I think that's critical. And like that's the most clear transmission mechanism in the US. But we also sit in the market in the US that the majority of people have 30-year mortgages, right? Like you just don't move if you don't have to. Whereas we look globally, and I think other markets are much more constrained by the mortgage markets, Canada, the UK, Sweden. And can we then have a divergence in policy as a result of that, right?
Invesco lives abroad mandate every single day. I want you to focus, I don't know if you're up to speed on this, but the ginormous Johnson & Johnson spinoff Clearview, Keenview, whatever it is, K-View. It's like K-pop. It's whatever they're doing with Band-Aids and Aveeno and the rest of it. Yesterday, 8 parts, Lisa knows this better than me, it was 6 times oversubscribed. Describe the demand for people now to lock in 10, 20, 30-year yields.
From a corporation side?
Yeah.
Yeah, I mean, I think people still look at, right, like yields are materially higher than we have been for the last 5 years, 10 years. But on a historical basis, right, even when we talk about mortgages at 7%, that seems outrageously high to the last decade that we've seen, but it's not the 1980s levels that we've had, right? Like these are still there. That's a more normal level than saying like, oh, my 2.5% 30-year fixed mortgage that I'm just going to set and forget and not worry about, right? Like that's the world of the free money, the Teslas of free money of the world.
You teed up a trade. Just a little bit. You said there were opportunities in FX at the start of the conversation, and near the end of the conversation, you talked about maybe differences in pass-through from rates into the mortgage market, shaping up potentially some division within policy in the upcoming years. So is there an FX trade within that story off the back of real estate?
I think that there is. And again, I think that we're finally within DM central banks starting to see this potential divergence. So as you guys know, we're generally have an EM bias and have been constructive on EMFX. And I think the story remains the same there, and we remain constructive. And I think even EM central banks have done so much. Even if the Fed does more, I'm not sure that they have to chase it. Perhaps you'll price out some of the cuts there, but we remain constructive on EMFX. And then the question against it is, what DMFXs are you short against it, or how do you fund it? So I don't know that it's strictly a dollar story. I think when we zoom out and we say, are we at the start of a 10-year dollar cycle of dollar weaker? Yes, I think we have confidence of that. On a more short-term basis, yeah, it's a lot less compelling to own sterling, own CAD, own Aussie because of these housing market divergences and the pass-throughs.
Well, your framework screams short sterling. Just screams it. But I won't put words in your mouth. Christina Cammani of Invesco, even though I kind of did. But I'm not suggesting you get short sterling. I've got sterling savings too. Futures on the S&P. Not that that matters, of course.
But better
down
gifts
a third
for the
of 1%.
family.
I just thought, be transparent. Better gifts for the family if the dollar gets stronger.
Right,
absolutely.
Totally. So
if the cat money world comes around, Christmas is going to be great for everyone at home.
Everyone's like cheering quietly at home for like a weaker pound.
Futures negative. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income levies on corporations and wealthy Americans. The plan has little chance of passing in Congress now that Republicans control the House. The UK plans to relax some data protection requirements under the European Union law. The bill includes reforms that would make it easier for British companies to mine user data for research and development. Businesses have cautiously welcomed the move. Privacy groups are critical. Bank of America has been one of the few major Wall Street banks to avoid mass job cuts. One reason is flexibility when it comes to dealing with staff. We spoke with CEO Brian Moynihan.
Or redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Moynihan says B of A's attrition rate is now approaching an all-time low. The bank has more than 200,000 employees. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud, we see a lack of transparency, we see run risk, lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the with the whole crypto space.
Chairman Powell of the Federal Reserve there on crypto. Silvergate Capital planning to wind down operations and liquidate its bank. A little bit more on that in just a moment. Your equity market shaping up as follows on the S&P 500. Futures a negative 1/3%. Yields basically unchanged on a 10-year. There's your 4 handle on a 10-year maturity. Your yield 4% at the very front end. The 2-year just north of 5. Comes in a couple of basis points on a session, 5.05%. We are about 43 minutes away from jobless claims in America, and then 24 hours after that, it's all about payrolls, Tom, and then it's on to March 14th and CPI.
Yeah, it's a derby that we're in right now, and we'll keep you monitoring the rates that we see and what we see on the screen as well. John, I'm going to go back in the conversation we just had here. There's only one statistic that I guess is the thermometer right now, and that's the vanilla 210 spread, and it really hasn't moved all that much from the shock of 2 days ago.
Seeing it in negative triple digits, though.
Minus 111, and we've barely pulled back. Minus 105 right now.
1981. Got to go back to 81 to something like this.
John, do you follow Bitcoin?
Not much.
It's grinding lower. I don't know what to make of it. 21,600. I don't. It's just this. Technically, it's a mess, and I don't know what to make of it.
As Chairman Powell mentioned, in the crypto space.
The crypto space.
Likes to call it.
Speaking of the crypto space, she's Bloomberg crypto space correspondent Shonali Basak joining us right now with an update. There was a point in, I believe, 1981 where a young Robert McTeer, who ended up running the Dallas Fed, and they had to look at 5 banks a weekend, 7 banks a weekend to shut down. So I know the headlines this morning is Bank A of the S names, but there's also a second bank, Signature Bank. It's New York State regulated. Do they make it to 4 p.m. this afternoon? Do they make it to Saturday?
There's no reason to believe that Signature doesn't. Remember, Signature, they are trading at 1/3 of what they were trading at about a year ago, but they do have less exposure to crypto than Silvergate.
They're not a pure play on crypto.
Exactly. Silvergate, 90% of its deposits were tied to the crypto industry by September of last year. And remember, this ties in very closely to the broader banking industry because there's a lot of question around whether the reason they got into crypto in the first place was because it was so hard to be a regional and community bank in America at that time.
What is next? I don't understand. I mean, John, was it 8 cups of coffee ago that every young stud in Manhattan was a crypto bank expert? I think it was like, what,
Basically,
9 months ago?
That was the thing. People were quitting their jobs to go and join this industry.
We're going to do crypto, do Christmas accounts, and give out Bitcoin. Is it dead?
It's not dead. Remember, Bitcoin itself
Why is it not dead? I'm not going to let you get off with that.
Right. So
why is it not dead?
If you think about it, we had a really great conversation recently for the crypto podcast with Jeremy Allaire. He is the person who runs Circle. No, well, think about it. He makes this great point that if you're paying via Venmo and you want to pay somebody in China, your Venmo account doesn't connect to their Grab account and you can't send them $100,000 via payment rails. So the payment rails in the country and globally are outdated. It is really hard to transfer money.
Use case makes a ton of sense.
Exactly. And USDC, stablecoins, that's the next part of this conversation. Stablecoins are backed by dollars, treasuries, and custodied in Bank of New York Mellon and managed in part by BlackRock.
Well, Jeremy Allaire is one of those who actually wants to see some of these banks fail or wants to see some of these crypto actors fail so that you can kind of weed out those actors, encourage some regulation around stable coins that are backed by assets that are audited, and get on with the use case scenario that we were just talking about. How much closer are we to that being a reality versus just simply the lowest hanging fruit getting washed out?
Lisa, to the extent that the regulators have entirely failed leading up to the collapse of FTX, stable coins would be the next place to start getting it together, because it is the most direct rail to the United States digital ecosystem when it pertains to the U.S. dollar. Remember, it's not like the United States Federal Reserve has their own central bank digital currency like China does. So stablecoins is really important. It's a huge on-ramp to the crypto ecosystem, but also a potential way to just pay for things digitally in a way that requires normal U.S. dollars, which is already, by the way, already happening.
So you get the sense that that is where the focus of regulation will be. We've been talking about this for months. How far does the contagion go? And it seems to have kind of lost some energy. People thinking, okay, well, there'll be a couple shoes, but otherwise things are kind of going to chug along as previously had been experienced. Is that true?
Well, think about it. Another firm is failing and nobody's really blinking an eye because people are getting so desensitized to firms failing, but billions of dollars are being lost in the meantime. Something else that's interesting is if you look at concerns from regional banks, once again, what they are concerned about is stablecoins. They're very worried that stablecoins will start to take up what more banks had previously done, which is why even community banks are pushing for stablecoin regulation because they're very worried about big tech getting into the
This is ancient history. The Reserve Money Market Fund, and actually Federated, led on this 1,000,000 years ago. Everything I read about stable coins believes the aim, the goal. There's no aim or goal. They want to be like a money market fund equivalent where we're always worried about breaking the buck. Do we have the audit process in place to study if stable coins are on a one-to-one basis, which with whatever the underlying is? I don't observe that.
And that's exactly right. If you look at some of the biggest stablecoin issuers, you just saw one essentially get pulled.
Then why are we talking about this? I don't understand where Gensler and the others are. And frankly, this is more a Fed-based issue, Lisa. I mean, this is not. This is serious stuff.
And that's the big question. Should they be regulated more like money market funds? Because that's what they look like.
I'm asking, what's the story?
I think one way to look at this, think about the way that some of these companies are using it. Coinbase, the reserve of USDC has been growing. And so, yes, they have $2 billion worth of cash, $2 billion worth of cash equivalents, essentially money market funds, and a growing amount of money in USDC. Will more firms decide to say, let's just hold USDC? It's held in BNY Mellon anyways, and then the Fed needs to start getting on it if that is a trajectory so we don't have another Silvergate in the future.
Before we let you go, just to shift gears a little bit, it is not Silvergate, it is JP Morgan. This story, this headline coming out where they're basically going after and blaming the former executive Jess Staley for some of their association with Jeffrey Epstein and the sex crimes that he was accused of and convicted of. What is this all about? Why are they highlighting Jess Staley as a part of this?
You know what's really interesting about this entire Jeffrey Epstein saga is that the reason Jess Staley even was in trouble in the first place is because European regulators started to look at that. That process never happened in the United States with financial regulators, not with any financial firm that had any dealing with Jess Staley. And now you're seeing this issue play out in court as it pertains to JP Morgan, not among regulators, because of the role that Jeffrey Epstein had at JP Morgan when Jeffrey Epstein was a client client.
Staley was pushed out of Barclays because of it. So what did Jamie Dimon say about it this week?
Yeah, I mean, the responsibility is being entirely pushed on to Just Daily, and on top of that, they provided a little bit more information than you're seeing in existing court filings, which is that they are alleging that he had a closer tie to the young women that are alleging wrongdoing when it comes to both Just Daily as well as Jeff
So they want all of his pay back from his time there, is that right?
$80 million or so, a lot of money.
How does he respond? Does he say no?
Yeah, he's been fighting it. He's absolutely been saying that this is not accurate, right? And so this will, again, play out in courts and not among regulators. But for Just Daily in particular, this is also playing out in international courts.
Shonali, thank you. Important story for us this morning on several fronts. Thank you very much. Shonali Basak there on the latest. Just to push forward for you, in the next 34 minutes or so, you get jobless claims in America. Then we'll push forward on to tomorrow when we get the payrolls report in the United States as well. Looking for something in and around 225. And the answer, the question that I keep getting on the Bloomberg from a lot of you this morning is just how low is the bar for that 50 basis point move from the Federal Reserve? Does 225 and 0.4% core CPI next week, month on month, get it
Lisa,
done?
I don't have any wisdom here.
What we've heard from people is, what is the greater liability? Disappointing and causing a more accommodative market, or going 50 and then be a flip-flopper that has to go back to 25 or raise another 50?
My answer is they're asymmetric, and the least risk is to stay 25, but that's, it's just blah, blah, blah.
I think the balance of risk shifted after Chairman Powell in the last couple of days. Futures right now down 0.2%. Andrew Sheets and Morgan Stanley coming up next.
Paribas Open update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Three-time major champion Andy Murray is the headliner on day 2 in the desert. The Scot takes on Argentina's Tomas Martin Echeverry in the opening match of the day on Stadium 1. And don't forget, you can watch all the action on Tennis Channel. Our daily live coverage starts at 1 p.m. Eastern. I'm Erin Coscarelli.
Why 1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War, it's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Although economic indicators look fairly strong today, there is pain probably coming ahead. So this is a bit of a head fake market rally.
I think that we haven't really baked in that rates might be much higher than we've expected for a long period of time because we just had 10 years of zero rates.
That rise we've seen in inflation expectations and market-based measures, that's what's keeping me up at night. That is moving in the wrong direction.
The next time that the Fed cuts, we don't think it's going to be back to the zero lower bound.
The Fed's going to wind up pushing us into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. In 30 minutes, you adjust and we adjust to get out 24 hours to the jobs day as well. John, I'm calling it 193,000 Thursday. That's the 4-week moving average of the claims number that we're waiting with bated breath for in 29 minutes.
Isn't that unbelievable historically? Just exceptionally low. We get that number in 29 minutes. The median estimate is 195. The previous number is 190. And as Tom pointed out, 24 hours away from payrolls in America. The median estimate right now is 225, the previous number. You're very familiar with that number, 517,000, which is just absolutely ridiculous. Andrew Hollenhorst of Citi published just moments ago. He said, we continue to expect a 50 basis point hike. Now, what's interesting about what Andrew suggested is it's 50 basis points with 225 on payrolls and 0.5% month-over-month core next week. That's how low he thinks the bar is.
It shows the uncertainty out there, and we got a whisper of this in Japan this morning, where not only real but nominal GDP adjusted for Kuroda's inflation induced was way off the mark. And you know, I wonder what the way off the mark study is for tomorrow. I just really don't know.
I think the big what if. What if you get a massive revision to that?
Well,
and then all of a sudden everyone's like, can I edit everything I've said in the last month?
Literally, we'll be talking about rate cuts. We'll be talking about rate cuts by September.
We have not heard this week from the crew looking for substantial disinflation down to 3%, or dare I say even lower. They're just sort of saying quiet, waiting in this data dependency.
We've had some great conversations in the last month, but one that stuck out for me was just James Athey of Aberdeen, who said this is table tennis narrative month to month. And I think we've said on this program as well, I've said it a few times, we've had 2 years worth of narratives in 2 months. And really the separating point, the dividing point was that February 3rd jobs report, Lisa, just the blowout.
My favorite part is that we're getting basically ping pong narratives daily now. We're basically shifting into something that's even more dramatic at a time when people can't agree what the bigger risk is. Is it inflation getting higher, or is it an economy crashing and causing everything to lose value?
And full disclosure, I am the worst table tennis player of the three of us. Lisa, I'm going to...
Actually, I'm really good.
I'm going to... Oh, excuse me, would you like to chime in here?
I've got nothing to say about table tennis.
She's the one standing 10 feet.
The floor is yours.
She's like 10 feet away from the table, like the Chinese, going like this, killing it here.
You're pretty good.
I am.
What is that, like really good?
Like I can.
You beat the kids.
I beat the,
you beat the kids.
I beat the kids every
That's like
time.
you laugh are really good at everything. It's
You
like
are
you
brutal.
beat the kids.
All right, let's move on. What were you going to ask?
You're just so driven. You know, but Lisa, to your wheelhouse, the
really
markets are ignoring this. Are we still on table tennis?
The markets are ignoring this. Carry on. All right.
Okay. The 3, 2, 1. The answer is the markets are ignoring this. Witness the J&J transaction at yesterday. Witness where the move is versus the VIX. Life goes on.
Well, the markets are ignoring what? I guess this is the question, right? Because we heard from Christian Miller-Glissman that actually, if you buy the economy, perhaps we're less sensitive to interest rate hikes, and all of a sudden you could get a higher recovery and risk still looks good. And then you have the likes of Steve Chivrone coming out and saying he doesn't like bonds because the risks are that you're going to end up with inflation that gets a little bit too hot, and going forward, it's going to lead to a credit problem, not a duration problem. I find that divide interesting.
Well, the Treasury market's been listening all week, that's for sure. 5% on a 2-year. Big adjustment at the front end of the curve, Tom.
It is. I mean, the adjustments there, the spreads, 105 on the spread is where we were. 111 was the worst, I believe, John, yesterday, and you see it in every single data point. But again, I'm going to go out that life goes on. Let's dive into this right now. Andrew Sheets is really quite good at this, chief cross-asset strategist, I should say, at Morgan Stanley. Andrew, coalesce in the wonderful and fractious narratives, plural, at Morgan Stanley. What is your conviction right now?
Well, thanks. It's great to be here with you. So we still think that the U.S. economy is going to slow as we go throughout this year. And I do think the market might be a little bit too fixated on this kind of will they, won't they question of a recession, when the dominant force we think is still going to be a slowing in economy, both in real and nominal terms. Now, the recent data that we had out of payrolls and retail sales was very strong. I think that definitely worked against that narrative, but we'll see what the data comes this month. We'll see how that data looks without those large seasonal revisions in the same way. And we still see a lot of leading indicators pointing to a slowdown. So we still think that we should be positioned for decelerating growth, weaker than expected earnings, and we still think that that will be the dominant narrative when investors reach the midpoint of the year.
You're underweight global equities, Andrew, so let's start there. Is that spread equally between regions, or are there regions that you favor over others?
So I think the story in Asia is actually pretty notably different from the story we see elsewhere. So I think if you talk to investors and you ask them, why are you concerned about markets? The concern is decelerating growth, high inflation, hawkish monetary policy, high competing rates on cash, decelerating earnings growth, expensive valuations. That's not the story in Asia. That's not the story with Asian equities. These are markets that are generally pretty reasonably valued versus history. Growth is going to be improving. Inflation is not high. The central banks in Asia are not hawkish. And cash as a competing asset is actually quite low in yield. So I think that this is a story where overall we still see a lot of signs that suggest that this is a time to hold less equities than normal, to be underweight equities. But within that, we're much more optimistic about stocks in Asia, and we think there's a legitimately different macro story there that could help support that.
How can you justify, Andrew, being underweight equities, yet more positive, more constructive on credit?
So I do think that this is an environment where I think it's a little bit better suited to credit. And some of that is that I think in a decelerating growth environment, that is still tough for earnings. My colleague Mike Wilson and our equity strategy team, we are very worried about operating leverage, meaning that earnings really underperform what you see out of GDP. But that type of decline in earnings, we don't think really creates major credit problems, major refinancing problems for the bulk of the credit market. I also think that when we think about incentives, as yields move higher, think about this from a corporate treasurer perspective. All of a sudden, paying down your debt looks a lot more attractive than buying back your stock if the debt is yielding 5.5%, 6%. And so the idea that at higher yields, we might get more credit-friendly activity rather than shareholder-friendly activity is another part of our thinking.
Andrew, to combine these ideas of both the international approach and picking different regions within equities, and also your appreciation of credit and how it functions, how different is the picture for credit in different regions based on what Christina Kampmann was talking about, which is that there are different regions with different sensitivities to rising rates, potentially more given variable rate interests?
So I do think that's a really great and important point. And I think across a lot of these different credit markets, you do see different outcomes. So a market like Europe is a market, especially European investment grade, is a market we like a lot. That's an investment grade market, yields 4.5% in euros. That's the same yield you got back in 2003 or 2004. And these companies have refinanced their debt to a pretty significant extent. It's some of the longest duration in that market that we've seen in its history. On the other hand, I think the leveraged loan market, where you have more issuers, where those debt costs are resetting quickly, there you have the feed through of costs that are much more significant. And my colleagues are also pretty cautious on the commercial real estate side. You know, we still think that that is a market where you could really get hit from kind of both directions. The cap rates need to come up as risk-free rates have come up, but then also financing costs are up significantly. And so that's an area where we're more cautious, on the equity side. And I think that's still an area where we probably want to avoid relative to parts of the corporate credit market we like more.
Andrew, just to take this an extra question, I'm quite interested by this theme that you have, that ultimately the C-suite will make decisions that benefit credit investors more than equity investors. Is this another way of saying I want to bet on fallen angels becoming rising stars? Is that a story that you like within high yield credit?
Well, I do think that this is an environment where I think the incentives to be more conservative and be more cautious would seem to be there. I think if you combine CEO surveys, which are pretty notable, that much of the C-suite seems relatively downbeat about growth. That's, I think, gotten a little bit better in the most recent month, but still relatively downbeat. And then just the math of where bond yields are relative to equity and dividend yields, that I do think that this is an environment where we want to play for credit improvement more broadly. So in terms of the fallen angels specifically, I think that could be a little bit more complicated, because I think there you are often dealing with companies with a little bit more cyclicality, and there it might be harder to support that given our below consensus growth forecasts. But I think I do think it supports the idea of credit versus equities overall within a portfolio context.
Andrew, thank you for that. Smart stuff. Andrew Sheets of Morgan Stanley, going into that data a little bit later with an interesting call there on credit, Lisa.
Yes.
You were asking the difference. Why do you like credit versus, say, equities right now? And there's the explanation.
I remember all of those years, I would look out at the prospectuses that would come out and they'd say, we're going to issue debt to buy back our shares. And I kept thinking, oh, why are they putting up with this? And it's because there was no alternative, and really they had no other options. And now they're pushing back. And suddenly, you know, it's looking a lot better to buy back those bonds. And all of a sudden, those shareholder-friendly activities go away, and it looks better from the credit perspective.
The leverage is not in the hands of the bond issuer anymore, so to speak, in the way it was.
Which is the reason why people like credit, even though there could be clouds on the horizon or tumultuous times ahead.
There are always clouds on the horizon, right?
They seem like they're greater right now with the inversion.
Aren't there always sort of clouds?
I can always find some, but I do think that, you know, right now...
They're darker.
They are.
You ready for the reality here? Feeding frenzy on the J&J bonds. I loaded the boat, John, yesterday. I got a call last night. Fidelity didn't want to take it all, so they gave me some of it. And this is out 40 years, 5.2%. And I went in large at par, and I'm already down 66 days of interest because the price has come down just since Bramo's been talking it down. That's a movement.
That's Lisa's fault.
The price down on a 40-year piece this morning.
I think that Jay Powell has nothing to do with it. Just throwing that out there.
Not at all. This is all you.
It's a new bond world, after all. It's like the old days.
Must be logistics.
20 minutes away from jobless claims. Nina Richardson, just wonderful, from ADP, is going to join us shortly. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Israel, tens of thousands of people headed for protests over the government's plan to cut power of the Supreme Court. There may be demonstrations in 20 cities. Now, protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would also be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. The only Goldman Sachs banker tried and convicted in the Global One MDB scandal, sentenced today in New York. Roger Ung says he suffers from a substantial mental health condition and shouldn't receive the 15-year term that prosecutors want. The government says Ung was a key figure in the conspiracy to loot the Malaysian fund of billions of dollars. And General Electric expects profit margins at its aviation division to keep expanding over the long term as an independent business. GE Aerospace primarily makes and services jet engines. CEO Larry Culp said he expects to see revenue growth at a mid to high single-digit rate. GE is set to break up next year with aerospace, its remaining business. Global news powered by more than 27 journalists. I'm Lisa Mateo. This is Bloomberg.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg. Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, Friday on Bloomberg Television and Radio.
If you want to solve inflation, according to their Blue Book, you've got to keep on raising rates. And of course, don't forget there's a political element here. They don't want to damage the Biden administration by raising rates too much and killing the economy. They're going to continue at this path in being very careful about raising rates, but at the same time, once the election is over, then they'll go full gun and raise rates.
It's quite an accusation that Mark Mobius is making, the Mobius Capital Partners founding partner, basically saying this Fed's not going as hard as it should do for political reasons.
I think a lot of people felt that that was the situation back in 2021, back in 2020. People think that perhaps there isn't the same kind of response to inflation that there should be. At the same time, we're not necessarily seeing unemployment go up or inflation come down, so you can make that argument, yeah.
I know. He's dressed for summer. Very cool jacket, Mark Mobius. It's very warm in here. It's like summer now, isn't it?
He's a great guy. I did a magical thing with Mark Mobius. I did a...
Tom's talking. Go on, Tom.
What are you talking about?
Nothing. She interrupted.
Okay.
Very rude.
Sorry, yeah. She's she's off her game today. What can we do here? 15 minutes away from this important jobs report. I did a magical panel with Mr. Mobius years ago, Dr. Mobius, I should say, and his depth of knowledge of how EM has changed is stunning. Is the EM now the same as our stereotype of the EM from 20, 30 years ago? I'm not sure.
Even 10 years ago. I think we just called it a commodity story 10 years ago, Tom.
All you did
And
is
now if you look at the benchmark, it's full of tech companies.
In equity, you bought the mobile phone company and the concrete company, and that was the end of your research. And those days are gone. I mean, it's just evaporated. You see this, I mentioned this right now, is printing. Argentine peso, 200 pesos. That's the frontier economies falling apart. And yet, to Mr. Mobius's point, you've got to find the economies that will do well.
Argentina will love you calling them a frontier economy.
I think a lot of people would call that. Nigeria, Tunisia, and a few others there on the IMF radar. On our radar now in the white marble of Capitol Hill is Henrietta Trey's Managing Director, partner, I should say, of Economic Research Veda Partners, always informative as well. I'm going to cut to the chase, Henrietta. The budget outlook at CBO is 19 Excel spreadsheet lines. The interest payment is modeled out at 6.8% of the budget, and it is jaw-dropping, their model of what we're going to pay in interest over the next 10 years. On a per-year basis, I thought it was a cumulative summation, and it's not. 10 years from now, we're going to pay $1.4 trillion in interest. Is it out of control?
I think everybody's going to make the case that it is out of control, but nobody's going to do anything to stop it. To put it in perspective, there's a $31.381 trillion debt ceiling, and we're talking about cutting $300 billion into the deficit. So it is definitely a humongous number. It will continue to rise, but there are no plans on the horizon to materially dent it. So get used to it.
Many others say calm down because the mathematics, the complex mathematics of this is wrapped around the growth rate of a nation versus the R-starred and the implied economics of the moment. Do we have the growthiness of America to get out 5 years, let alone 10 years?
I mean, I think you obviously have the growth right now. And another question is, how does it compare to the other nations that are coming out of the COVID still, that are in recession, dealing with bigger inflation than we are? A big question about it in sort of the morality circles of economic policies. How much does it matter? And what are we looking like compared to our peers, the rest of the globalized economy? So I think in general, the feeling is, and the voters are telling you, we love to rail about the deficit when it's convenient, but we don't have any bandwidth or the backbone to actually do anything about it. So you'll see that play out in the Social Security or the Medicare debate. You'll see that play out with Republicans calling to extend the 2017 tax cut, which alone was a $5 trillion bill, $1.5 trillion of which was pure deficit increases. So nobody's really willing to do anything about it, but they love to jawbone about it.
Which is a reason that maybe we're going to be talking more about TikTok than the debt ceiling debate coming into the election season, just because it's easier for people to wrap their heads around. I mean, is that basically how you can interpret some of the discussion and the unity that you see within parties that otherwise is lacking?
Absolutely. This is entirely about comparing and contrasting. And what's interesting about American politics right now is that almost everyone unanimously believes that China is a problem. So you'll see this president's budget come out later today with $885 billion just for defense. That's humongous for a Democrat or a Republican. And then on the other side, we have the issue of China. Obviously, you have all these defense folks coming out saying we need more capabilities on the defense side, but we need to continue to bolster Ukraine because it's a proxy war for what China would do to Taiwan. So there's just this tremendous focus on China from every direction, whether it's IP, defense spending, TikTok, AI. It's across the board. I think view the budget and the deficit conversation through the lens of China, and it helps everything make sense.
Henrietta, given the needs or the asks with respect to spending, and given the reluctance on all sides really to raise taxes ahead of an election season, and it's always ahead of an election season, what is the likelihood that we really have a problem here with respect to the debt ceiling debate that's different, that has a different character than the previous debt ceiling debates?
I was just talking to a dear former colleague, Pete Cohen, about this. I love that everybody says this time is different, this time it's a calamity, this time it's a train wreck, the House is a disaster. Exactly none of that is different from how it was in 2011, 2013, 2016. I mean, we have seen 2 consecutive Republican speakers' heads roll as a result of conflating the debt ceiling with the government funding bill and relying on Democrats to provide the bulk of the votes. And that's precisely what's going to happen here this year as well. So I find a lot more consistencies than differences, and the dysfunction is a normal part of, especially the House of Representatives.
Henrietta Trace, one of the best, always great to get your thoughts. Henrietta Trace,
The
there,
level of
Vader
Washington
Partners.
cynicism is off the chart.
Let's be clear, though, and connect that Washington cynicism with how markets will at least take that point. The biggest risk is that people believe that it isn't different this time. And because people believe it isn't different this time, they'll ignore it, and they'll keep ignoring it. And guess what will happen as they ignore it? There will be no pressure on Washington, D.C. to come to any agreement, and that's why this is going to push right up to the edge.
My point is, like 2011, that operative mathematical word, suddenly. Everything's fine until suddenly it's not.
And when you start to believe it's different this time, that's when the market will move and they'll come to an agreement, suddenly, to your point. And let's hope it doesn't go that far. But ultimately, that's the fear that some people have about how this might play out later this year.
I'm concerned that it is an incredibly difficult issue with a lot of tough choices to be made, and how much of the nuance gets lost in a discussion where you're talking points. I mean, really, we're talking about a massive budget, real issues, higher interest rates. These are all important discussions. And, you know, what are younger individuals in my household talking about? They're talking about TikTok and daylight savings and whether it's going to get kicked out. I mean, I'm just wondering whether that makes their job trickier, because there isn't as much room for nuance, especially heading into an election
I remember
season.
10 years or so ago, do you remember when President Obama was going around saying the market should take it seriously? It's almost like they were willing the market to sell off and do something dramatic to push everyone to come together and come to an agreement. And right now that's not happening, and may not happen until much, much later in this summer, if at all.
My long-term moving average on claims coming off the great financial crisis, are you ready? 400,000 was normal coming off the crisis, is a smooth moving average. It's shocking how far we are from any kind of normal on this number in 5 minutes.
Mike McKee's lurking in the shadows. Can you see him in a studio? Mike's turned up already.
I can't see that.
Mike's ready to go.
See over there.
5 minutes away from
he's
claims.
hidden by his entourage from where I'm looking.
195. Mike McKee's in the building. You know what that means.
He's in
Some
the building.
data's about to drop in about 5 minutes' time. 195 is the median estimate in our survey. 190 is the previous read. And then from there, the dance continues into payrolls tomorrow morning. 225 is the median estimate so far
75 basis points
in our survey. I'm not sure what it would take to get 75. Tell you what, you get a repeater last month and there'll be some talk of it. CPI still to come next week.
Why can't they take an eighth?
From New York City, this is Bloomberg.
3/8.
We have only 8% of the ocean protected today, and our Earthshot is as Patty said, 30 by 30, 30% of the ocean at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
From 2009, a glide path lower in claims, a more fully employed America, the pandemic getting in the way, changing that mathematics, and then the stunning shock of sub 200,000 fully employed American claims here week after week after week. It is not an embargoed statistic. With his first look at this anticipated statistic, Michael McKee.
Well, we are waiting for this first look. I guess a lot of people clicking on the internet at this time because the Labor Department drops it all at once for everybody, and here we go. 211,000. So Tom's week after week after week was just interrupted by a change in the direction and the amount for jobless claims. 211,000 is a pretty low number, but it is a significant change from the trend that we have been on, which was week after week after week of numbers coming in below estimates. I think 13 of the last 14 weeks we had jobless claims below the estimate. Well, the estimate was 195, so we're significantly above that at this point. Now we're looking to see if last week, I'm looking to see if last week was revised at all and revised higher, and I still don't have that number. There we go.
Continuing claims, but we
continuing
don't have
claims. We should mention this because this is also a change. Continuing claims going up 1,718,000 from 1,649,000. So we are seeing people taking longer, perhaps, to get jobs, and that's going to be. This is going to be the kind of trend that the Fed and everybody who has been predicting a slowdown in the labor markets is going to be looking at. Now, what we don't know, of course, is whether this is going to continue, but we are anticipating that it should. It was an increase, the 211, by the way, was an increase of 21,000. They did not revise.
They did not revise. Okay, that helps
the prior week.
Let me do this. Let me do the markets right now, Michael, and I want to come back to you. And we see some real activity. We just see it with the green and the red blinking on the Bloomberg terminal. Futures somewhat catch a bid here, flat on the market right now. The 2-year yield 5.03%, indicating 4 basis points in. 10-year yield flat 3.98. 2-10 spread, Lisa, 111 basis points of massive inversion. We migrated back to 106 basis points, and we do a little better now with less inversion getting out in front of the story tomorrow.
It is so hard to game out because we're talking about not that many jobs, and we're talking about this question of just how low we're coming from in terms of a base. The fact that people are trading on this at all, though, highlights how uncertain we are at a moment where the Fed is watching this data so carefully.
I mean, I look, Mike, at the trend here in the 211. I'm going to say I'm doing this real quickly. I can't be like McKee folks. It gets me back to the end of December 2022 off of the set of 6, 7, 8 data points as well. Can you figure out state by state where that jump came from 190-ish out to 210?
You can on a delayed basis. Is the problem is we don't get
can a big state or a little state jump it out of whack?
Well, no, because you're looking at total claims here, but you're going to be looking at states that have the largest working age population, unless there were a strike or something in a plant in a company. So the week of February 18th, the prior week, it was New Jersey and Rhode Island with 2,500. It looks like those were the highest uninsured employment rates. The largest increases in claims for the week ending February 25th, which was last week. Massachusetts up 4,000, Rhode Island up 1,200, and New Jersey up 742,000. So yeah, you get a reaction.
So you get
there.
a little bit of state granularity.
Interestingly enough, California was down 2,800, and Kentucky was down 6,164. Ohio down, Michigan down. So the biggest states were seeing declines. Right. Kind of hard to put this all in perspective, because you would expect, if we were seeing a lot of tech jobs to go away, that California would be leading the pack, and they are not at this point, although we do still have that whole thing about getting severance pay and that keeping you out of the claims market.
In-N-Out Burger's been hiring. That's what this means right now. Equities lift here. We just showed it. For those of you on radio, the NASDAQ with a nice spike here, a little green on the screen, flat on the SPX, Dow up fractionally 38 points, the VIX 19.33. Speaking of granularity, and of course I went there with Michael McKee to stagger to our next guest, and she has the advantages of working for automatic data processing. Neela Richardson is chief economist for the people that punch out the payroll checks like nobody, from sea to shining sea. Neela, at the ADP franchise, what do you see in your ADP granularity?
We see wages are strong. Look, ADP provides payroll services for over 25 million workers. That's about 20% of the working population. And we're tracking wages very carefully, especially as the economy is looking in the face of inflation. And what we're seeing is a little bit of a deceleration in pay growth, but still too high to be consistent with a 2% target. And that speaks to the tightness of the labor market. It's not maximum tightness right now. We've seen things come down. We've seen jobless claims go up. It's not at the maximum like it was in the summer and early fall of 2022, but it's still very, very tight compared to where we were before the pandemic, even though the unemployment rate is about the same.
How difficult, Neela, is it to talk about the labor market as a whole rather than the specific parts? And I say this because yesterday in the Beige Book, there was an anecdote about a construction company commissioning a plane to fly workers out to it because that was cheaper than trying, and actually more effective to get workers, not even cheaper, than trying to hire in the region. I mean, how much are you seeing strength that you've never seen before ongoing in specific industries?
It's a very fragmented market. To your point, Lisa, some parts of this economy are so interest rate sensitive, housing, construction, and yet some of those sectors are chronically undersupplied, housing, construction. And so you're seeing a real mix in the market right now. There are companies that overhired or maybe extended their hiring aggressively during the pandemic. You're seeing those same companies pull back. There are smaller companies that we track in our data that never got really a leg into this market because the labor market was so competitive and they had to compete for talent with larger firms. So it's really a mixed bag, but the common thread is that wage growth has been stronger than before the pandemic throughout the economy.
How bifurcated is it that wage growth among the lower income sectors has outpaced the higher income sectors pretty substantially? I mean, has that gap continued to widen as you see some of the layoffs in the tech sector and the white collar, the middle office workers that have gotten stripped out of certain areas, while you still see some of these service sectors continue to robustly hire?
Yeah, so we still see double-digit wage growth in leisure and hospitality sector and the ADP data. And that growth has come down. It's down a lot since, again, the summer of last year. But overall, the wage moderation has been really, really modest. In fact, there's only a couple sectors where wage growth now is lower than it was before the pandemic. Information tech is actually one of those sectors. So even though as we're seeing layoffs, we're actually seeing information in the tech economy decelerate, the sharpest decline in wage growth of any other sector. That's notable.
the markets here recovering here. They were in negative, a lot of red on the screen, and we're back to a mixed red and green picture here. S&P futures at negative 1.50. I should point out that widely watched 2-10 spread, what the pros watch, is now at 105 basis points. Interesting to see if that breaks to less inversion. Neela Richardson, I just did a very informal long-term moving average study of claims out 8 minutes ago, and critically, the long-term moving average in March of 2020, the end of the pre-pandemic, is the same as it was right now. 219,000 is a close approximation of any arbitrary long-term moving average there. Are we back to pre-pandemic?
No. The economy has changed structurally. There's so many things that are different than they were in 2020. Just the advancement and adoption of hybrid work, for example. The fact that we're seeing double-digit wage gains in the lowest part of the pay scale, that's a complete change from the pandemic. During the pandemic, these low-wage workers were barely keeping up with then very low inflation. So we even saw declines year over year in pay growth for the lowest end of the spectrum. These workers have become much more competitive post-pandemic, as noted by the double-digit wage gain. So the wage structure has been turned around in the last 3 years. And the question is, will that endure through the next 3 years?
Neela, before we let you go, we're hearing from a little birdie named Michael McKee that the whisper number for tomorrow is currently 247,000. Do you think after 247 million, being created, I'm curious from your perspective, 247,000, what you believe will be the number based on the anecdotal information that you're seeing come out?
I think you're going to get a solid number. Let's start there. I think you're going to get strong job growth based on the private sector payroll data that we are seeing in ADP. We're not predicting the BLS. We're just looking at the market as we see it. And if you compare that with other data, like jobless claims, like job openings, you're still seeing a robust gain. But I don't think you're going to get 500,000 jobs.
We should have you on every day. Neela Richardson, thank you so much. I can't say enough, folks, about the granularity of payroll analysis and automatic data processing. To be clear here now, legitimate green on the screen, futures up 3, Dow futures up 56, a VIX 19.33. We're even seeing the 2-year yield come in 6 basis points. So, people are digesting the data, and as you say, Lisa, brilliantly reclaiming towards the whisper number tomorrow.
Right. Do we end up having this feeling that perhaps it's not going to be as robust as we previously thought, that the Fed won't feel that much pressure to go 50 basis points at the March 22nd meeting? I don't know what the answer is. To me, the volatility on the backs of all of these numbers is instructive in and of itself. This feeling of how much the view of the market and the narrative hinges on specific numbers, the big one being tomorrow.
It's the parlor game of it. I get it. We've got the tools to do this, the Bloomberg and all sorts of other data and stuff, but the answer is you just wait for the data, which we just did, and it pulled back a little bit.
I wonder how much people aren't really trading the cash instruments and they're just basically hedging on the margins.
A lot.
I feel like that's kind of what's happening more than actually going for the level.
There's been some good academic study about that, and there's a lot of just noise out there. A critical conversation on Ukraine, Russia, and Putin. William Browder of the Hermitage Capital Management will join us. This is must listen. We do that next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income levies on corporations and wealthy Americans. The plan has little chance of passing Congress now that Republicans control the House. Senate Republican leader Mitch McConnell has been hospitalized after falling Wednesday night in Washington. An aide said McConnell tripped during a private dinner. No word on how badly he was hurt. McConnell is 81. He was elected to the Senate in 1984. Bank of America has been one of the few major Wall Street banks to avoid mass job cuts. One reason is flexibility when it comes to dealing with staff. We spoke with CEO Brian Moynihan.
Or redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Moynihan says B of A's attrition rate is now approaching an all-time low. The bank has more than 200,000 employees. And Boeing will work with Shield AI to speed up the military's use of the startup's self-flying aircraft software. The two will also explore other defense applications for the artificial intelligence technology. Shield AI's HiveMind software has been deployed in combat planes and drones since 2018. Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
The IC continues to monitor Putin's reactions and his nuclear saber rattling. Our analysts assess that his current posturing is intended to deter the West from providing additional support to Ukraine as he weighs a further escalation of the conflict. He probably will still remain confident that Russia can eventually militarily defeat Ukraine and wants to prevent Western support from tipping the balance and forcing a conflict with NATO.
April Haynes, National Intelligence Director here, as we're all shocked by the reports that we see in the newspapers on Ukraine. A few days ago, I asked our great Lee Brody, can you figure out where Bill Browder is and can we get him on the show here? And this is really important. Here's an email, folks. I've never received an email like this. Bramo, I don't think you have either. Quote, I write to warn you about the assassination plot against you by the Russian security services and the foreseen future to happen. I did receive the fresh info on directly identifying you as a target for hit. That is the Bill Browder reality.
That is not my reality, I
That
will
is
say.
not our reality or many others as well.
Yeah, that is a culture that has been unearthed and has been behind in some ways what we've been witnessing over in the Eastern European region.
The book is Freezing Order, Bill Browder. I can't say enough about it with the clarity of 3, 4, and 5 years ago. Mr. Browder joins us this morning from London. Bill, I can go 8 ways here, particularly off of Angela Stent's work on Putin, my book of the year last year, but I can't. We've got a battle of Stalingrad going on right now in Ukraine. The Russians had to stop the Nazis, and they did with a wall of bodies. Translate that analog that Mr. Putin knows over to what we're witnessing in eastern Ukraine this evening.
But Putin basically doesn't care about the number of casualties. He has this huge military advantage that death of his soldiers doesn't even make him sleep worse at night. And so they're losing soldiers at a rate of 5 to 1 of the Ukrainians right now. They're throwing convicts, conscripts, and anyone else who they've been able to corral into this meat grinder. They're throwing them into battle, and they're being mowed down. These people oftentimes don't have even the proper armor, guns, or whatever, and they're being shot down on a major basis. And the purpose of this is to try to just soften up the Ukrainian lines. And no matter how good the Ukrainians are at fighting back, if wave after wave of soldiers are being thrown into this meat grinder at the Ukrainians, it has a negative impact, and that is going on right now as we speak. And it's, if you watch All Quiet on the Western Front, which is about World War I,
Right.
this is the same type of tactics that are going on right now as we speak in Europe today.
An Oscar contender there. Bill Browder, when you were in Chicago, you and I were weaned on Thomas Schelling, the giant theorist on war and game theory. You've been courageous about saying, look, this is all about Putin. But what has changed in the last year? When Browder talks about Putin now, what's new?
Well, the main thing that's new is that Putin is showing himself to be, totally not credible in all of his chest-thumping alpha male threats. He has a weak military. He didn't win in 3 days. He's running out of ammunition. His gas blackmail against Europe didn't work. They found alternatives. He thought that Europe wouldn't, in America and the Allies wouldn't react harshly. We have. He thought we wouldn't supply weapons. We have. And so he's completely, I would say, misjudged this war from start to finish. And as a result, Russia is not in a strong position. Russia is not going to win this war with the capacity and the capabilities they have right now, particularly if the West continues to provide weapons, which we're doing.
Which raises a question, how can we expedite the end, especially if it's basically a meat grinder at the front lines, which is tragic to watch on all counts. You used to be one of the largest foreign portfolio managers of Russian assets. I mean, how far we have come from that time. Financially, have we done everything possible to perhaps expedite an end to this tragedy?
Well, there's really two areas that we need to be continuing to help the Ukrainians on. The first, on the military side, is that they have asked for jets, which we have not provided. They've asked for long-range artillery, which we have not provided. And they've asked for a certain number of tanks, and we've only given them a fraction of what they've asked for. On the financial side, it's the one thing we can really do for them is to starve Putin of the financial resources to continue to fund this war. And we have done a lot on the financial side in terms of sanctions. But the one huge loophole in this whole system, is, and you could drive a truck through this loophole, is the sale of oil and gas from Russia to the West and to the East. Putin receives between $500 million and $1 billion a day, even after all these sanctions, after all the disconnection of Russia from the Western system. And that money is enough money to continue to fight this war into perpetuity. And so we have to figure out a way to stop him from getting that money, because as long as he gets that money, there's no stopping this war from his perspective.
It's deeply painful to read the articles, the very human articles about what's going on, the fighting, the victims of this fighting. Bill, I wonder how long it will take and whether this war can end with Vladimir Putin still the leader of Russia.
Well, there's two ways that this war could end. We could give the Ukrainians enough military weaponry so that they finally overcome Russia, which I think they have the capacity to do. Or the other thing that could happen, and this scares me a lot, is as the war drags on, and again, as I should point out, that Putin doesn't care about casualties, and so he can throw more and more men into the meat grinder, more and more casualties, and as it grinds on, the West can lose interest. And you're starting to hear noises in Washington, particularly out of the sort of far right of the Republican Party, the Marjorie Taylor Greene, Lauren Boebert, the Tucker Carlson, let's not finance Ukraine anymore. That's what they're saying. And if those fringe people start to become mainstream, America is the single most important backer of Ukraine right now. And if America were to step out, if there was a change in leadership in 2 years' time, Putin could win the war that way instead of winning on the battlefield. And so that, in my mind, is probably the scariest prospect that we're facing right now as far as Ukraine is concerned.
Bill Browder, can the dramatic exercise work now? The Ukrainians shocked with damage to a key bridge to Crimea a number of weeks ago. So many in the West seem to be looking for a dramatic moment to put Mr. Putin in his place. I'm guessing that's the thinking of children.
Well, not necessarily. Remember in the summer last year, completely unexpected for me and for anyone else who's been following this, the Ukrainians broke through the Russian lines and retook 54% of the territory that Russia had previously taken. It was dramatic. All the different places they pushed Russia back, and the Russians were running back, retreating. And it's not entirely impossible. And interestingly, where I get this little inkling that there's some chance of that happening is from the Russians themselves. This guy, Yevgeny Prigozhin, Putin's chef, the head of the Wagner group, this mercenary group.
Yeah.
He's out there screaming bloody murder, saying, if I don't get enough weaponry from the Russian government, we're going to collapse, and then everything will collapse. He's the one saying it. No one else is saying it. He's the one saying it. Now, it may be for internal political reasons, but if I hear him saying that, it makes me feel like, maybe there's a second chance for the Ukrainians to do the same thing that they did last summer. On the other hand, Putin has unlimited numbers of people he can throw at this, and he doesn't care whether they die.
Bill Browder, thank you so much for joining us with this update. With Hermitage Capital Management barely describes it. The book is freezing order. I will not mince words. It is chilling, to say the least. Lisa, it's intractable there, and I think the coverage of Maria Tadeo and Anne-Marie Horton has just been so good on this. And frankly, the coverage, I find myself reading the New York Times, the battle reports, like from the lines. But what's chilling there is for Browder, who's really up to speed on this, alluding to this horrific modern movie, All Quiet on the Western Front, getting rave reviews for its brutality.
We thought this kind of warfare was over.
Exactly. Yes.
We thought we wouldn't see trench warfare. We thought we wouldn't see the levels of casualties that we hear and that we read reports of every single day. And yet here we are with a leader of a nation who does not care about casualties, as we were just hearing about.
We'll have to see. Bill Browder there, and we'll have much more from Maria today on Anne-Marie Horton in the coming days. What we're going to do is stagger here forward into jobs report after that claims report, pulling back a little bit more, employment angst. Equities catch up, futures up 3, Dow futures up 53. In the yield space, okay, we'll go with it. A little less inversion this morning than the shock of the last 2 Powell days. Please stay with us. Tomorrow morning, beneath the headline numbers at 8:30, it will be Jobs Day. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Equities just about turning positive in the last 30 minutes or so, a rally in the Treasury market off the back of jobless claims coming in just a little bit higher than anticipated. Your equity market positive 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, Chair Powell softening his tone on day 2 on Capitol Hill. President Biden delivers his budget request to Congress, and jobless claims inching just a little bit higher. We begin with the big issue. It's payrolls. Up next.
We've got key data coming up.
On-farm payrolls, a big important print.
The payrolls report on the 10th.
We're still looking at a labor market that is
if we don't see February kind of reverse some of January's strength, it's likely we do go 50 basis points at this next meeting.
200,000 on payrolls is an improvement, but it's still too hot.
It will matter a lot to markets if it is 50 basis points.
If there's an upside surprise tomorrow, and if there's upside surprise on CPI, the 50 is definitely on the table.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
Payrolls tomorrow morning, then on to CPI next week. With us, PGIM's Lindsay Rosner and Colin Martin of Charles Schwab. Lindsay, first to you. Day 1, day 2. Day 2 with Chairman Powell felt like a slight walk back from day 1. Did it change much for you?
It didn't. Certainly felt like a little bit of a walk back, but I think we all heard it loud and clear on the first day, which was the data has not given them much room to do that stair-step function that we thought was the plan, which was take it down to 25 basis points next time. Instead, we are now hanging on to every data print that we're going to get over the next week to figure out if it's going to be 50, and it very well could be.
We're data dependent. How low is the bar right now? 450. Citi tries to answer that question. They look for 50 from the Federal Reserve. These are their numbers. They're looking for 0.5% month-over-month core CPI next week. Tomorrow morning, they're looking for 255,000 in the payrolls report. Colin, I guess that's the question to you. How low is the bar, and does 255 and 0.5% month-over-month core CPI get it done?
I don't know if that does get it done. I think the bar is still relatively high, because if we look at the jobs picture, clearly last month there was a blowout report, but we know that 1 month doesn't necessarily make a trend. So when we look forward to tomorrow's report, if we get another blowout number, I think that certainly puts the odds of a 50 basis point rate hike significantly higher than where they are right now. If it comes in the high 2s, even low 3s, I think you need to then pair it with a very, very strong CPI report. Again, we don't want to look at too much at 1 month's numbers. As Powell mentioned, they look at the totality of the data that's coming in. So I think the bar is relatively high, and a kind of modest outperformance or slightly up positive surprise tomorrow, that probably won't move the needle in our view.
What if it is a big number? What if next week is a big number 2 and they go 50? Bob Michael of JP Morgan Asset Management spoke to our colleagues here at Bloomberg, and he said to go back to 50 would be pretty confusing to the market. I hope they don't do it. I hope they're willing to run a string of 25 basis point increases. Lindsay, why is that important? Why would it be confusing if they return to 50, even if the data justified it?
I totally agree with that comment. The move back to 50 is just not the playbook we thought we had. And so what we thought we were trying to figure out or wrap our heads around as investors was, when does this end? And they're at this pace from 75, they go to 50, they go to 25, and then they stop. And the idea that they could go from 25 to 50 and do that jump, well, that's explained a lot of volatility that's happened in the market in the past few days, because it wasn't the course that we thought we were on. I think the really important thing here is that the Fed is, yes, data dependent, but it's not a self-driving car, right? There is still a human being behind the wheel. And so with this data, there is some human finesse. I think we're trying to figure out how good is that human finesse, and is it going to be good enough to make sure that we don't get into that recession that people are fearing.
Lindsay, as you've suggested, we've had 2 years worth of narratives in 2 months. And as you pointed out, the divided line between those 2 months was that Feb 3rd jobs report from a month ago. And it made me wonder over the last couple of weeks, Lindsay, and I wonder how you feel about this, just how brittle both arguments are on either side of all of this, for them to break down in the way they did with one jobs report, 1 month of data.
Yeah, I think that's a great point. The world has been different since February 3rd. It was funny when I was thinking about what to say today. February 3rd really lines up perfectly with the groundhog, right? He predicted winter. Maybe we should have been listening to him. This week's data will tell us if we're going to, in fact, have spring. But the point that you're pointing out is that we are swaying in the wind with every data print. And that's kind of a challenging place to be in. I think on the bright side, what we do at PGIM is pull that camera back and be long-term investors. But in the immediate and thinking about day-to-day positioning and trading, it's gotten really complicated.
It was the dilemma of last year. If you can't price the risk-free rate, how do you price risk? And here we are again, struggling to price the risk-free rate. Deutsche Bank pointing out, what on earth is sufficient restrictive? Matt Lazzetti over at Deutsche Bank saying this: the market should not be comfortable with the notion that a terminal rate near 550 is sufficient. Colin Martin, what is sufficient?
You know, that's what we're all trying to figure out right now, John. What we look at when we look at the natural rate of interest is one of the Fed models, but they discontinued or suspended that model once the pandemic hit. You know, going into the pandemic, that natural rate of interest had been falling for years. It was in that 2 to 2.5% range. But as you alluded to, maybe it's a lot higher right now. Maybe not necessarily structurally, but at least cyclically. Because what we've seen in the markets, we've seen a lot of tightening in Fed policy, but not tightening in financial conditions. I think that's one of the confusing issues when we hear those comments from Powell. What is it that he's referring to? But when we look at the economic data, when we look at the strong labor market, when we look at that, you know, positive surprise with retail sales last month, clearly a rate of almost 5% isn't really restrictive right now. So I think that's what we're trying to figure out. And I think that's what we're looking at when we look at our guidance for our clients at Schwab. If it's not restrictive enough, and the Fed does need to hike more than expected, and the economy can withstand that, then maybe we see all yields rise pretty much all across the curve. That's not our base case right now. We think long-term yields are probably going to remain relatively anchored here for now. But if the economy is strong enough, then we could see a move up pretty much all across the curve.
Well, yields are falling this morning off the back of this. Jobless claims about 37 minutes ago coming in at 211. The estimate was 195. Equities up by, let's call it 0.25% on the S&P 500 into positive territory. In the bond market, yields are lower at the front end by 7 or 8 basis points to 4.99. That's just a slight upside surprise. And it's generated a move of 7 or 8 basis points on a 2-year yield to 4.99, just below 5%. Mike McKee, go through the data for us. Jobless claims, what do you make of that?
Well, we have been waiting for claims to go up because of all the layoff announcements we've had and because the Fed has been raising interest rates, and you're supposed to lose jobs when the Fed raises interest rates, and it looked like we did this time. 211,000 is the total for last week. First time since the first week of January, we were over 200,000. Unfortunately, this has turned out to be something of a head fake, and this comes from Stephen Stanley at Amherst Pierpont Santander. He notes that every time New York schools go on vacation, which they were winter vacation last week, you get a spike in jobless claims because the school workers can file. And so we saw an increase of a little over 16,000 in jobless claims from New York State. And you can see all the bumps every time that happens. And that would have left us below 200,000 again if that hadn't happened. So our neat little tied in a bow story doesn't exactly work. However, as we get ready for tomorrow, there are some reasons to think that we could see the numbers go down, not just the statistical reasons, but take a look at this. The Fed's been raising interest rates, and at the same time, we have seen strong housing construction that is now falling off. The number of building permits has dropped dramatically, and yesterday we got the JOLTS report. The number of job openings for construction workers fell by more than 200,000, almost 250,000, one of the biggest drops ever in that category. So theoretically, that stuff should start to show up. Maybe it shows up in tomorrow's payroll report. You can see, though, what John was just talking about in terms of the reaction of the markets. I mean, since February 1st, everybody has priced in the idea of 50 basis points and the idea that the Fed's going to raise a lot. And we've all been warning, hey, let's wait and see what the data say. Data today may be a head fake, but it has moved the markets. So tomorrow, there is certainly market risk to the payrolls report.
We've had a 100 basis point move at the front end of the curve in the last month or so. Mike McKee, thank you. Looking ahead to payrolls tomorrow. Median estimate right now, 225. The range we've got, the high estimate, 325 is the high, the low is 100K. The previous number, as you know, we talked about it almost every single day over the last month, 517,000, which was just unbelievable. Looking at this yield curve right now, 2s, 10s, negative 103 basis points. Yesterday, off the back of ADP, negative 110 plus. Just incredible to see this kind of stuff. We haven't seen it since the early 1980s, 1981 to be precise. Lindsay, as you look across this yield curve, we were told it was the year of bonds. Hasn't quite turned out that way. It's certainly the year of income. Where do you look to take that income right now?
Yeah, I think that's a really good distinction that you just made. We haven't changed our tune in terms of the fixed income market giving you opportunity. That opportunity is still there, and you still have the ability to do the right thing, which is you can stay in front end carry paper, whether that's the investment grade universe, selective names in high yield, really high quality structured product, which is a favorite of ours, and you can earn that income. That's really important. I think the other thing, though, when you pull the camera back, is that this is, I think, the year of the bond, or we think the year of the bond, but it's March, right? And we never said it was going to be a straight line. So we're a couple months in, we've got a long way to go. And that's where finding those the right kind of collateral, the right kind of paper that gives you a lot of spread, that's the place to be.
Well, high yield spreads are certainly tighter over the last year, that's for sure, well off the wides of last year. We were inside 400 basis points earlier this week. We've widened back out in the last couple of days to about 4 percentage points. Colin Martin, you didn't like credit before. You don't like high yield now. What is it about it that you don't like?
Well, mainly those credit spreads that you alluded to. We think it makes sense to take risk if you're being well compensated for it, and right now you simply aren't. I think a lot of investors might see that juicy yield that high yield offers, right, around 8.5% on average, but about half of that yield is strictly from the level of Treasury yields, again, levels we haven't seen in multiple years. But the risk premium is low, and three things that we really focus on that gives us a little bit pause and why we suggest caution as we enter now is, one, that low level of spreads. Two, historically, when the yield curve is inverted, high yield bonds tend to deliver negative excess returns relative to treasuries. We look at that in just in absolute terms of is it simply an inverted yield curve? But But as you mentioned before, negative 100 basis points on 2s, 10s, it's severely inverted. So we think that's the second risk. And third, just the general outlook. When you look at things like the ISM Manufacturing Index, that downward trend usually results in higher spreads, and we just haven't seen that yet. So while the all-in yield probably looks attractive for a lot of investors, we'd rather wait for better opportunities, even though we continue to kind of push back that potential arrival of the recession. We'd rather not take that risk now because there's so many attractive yields with high-quality options now, and we wait for better opportunities with high yield down the road.
You're not the only one who said that. They're looking for high yields, wider spreads later on this year. Lindsay, don't fight the Fed is a phrase a lot of people throw around on programs like these. Don't fight the Fed. What does success look like for the Fed? And what does that mean when you think about where you want to take risk? If I don't want to fight the Fed, what should I be doing?
Yeah, no, it's definitely something you hear all the time. If you don't want to fight the Fed, I think it goes back to finding the companies that are going to win. And the high yields that Colin was alluding to, yes, that's on the whole index. But if you can pick apart that index and find the names that are giving you those high yields and you think you're actually going to realize them, that's what you should be doing. And you can safely do that in an environment where the Fed is going to have to hike. Even if they do hike 50 basis points, if you are comfortable with the balance sheet of the company that you are investing in, you will get paid. And I think that's the way to handle it.
Lindsay, Colin, sticking with us. Equity futures right now up 0.25% on the S&P, about 16 minutes away from the opening bell. Let's get some movers. Here's Abby.
Hey, John. Well, a piece of that bullish action is GE. Shares of the industrial company are set to open at a record high. This as the company yesterday did provide an update on some of its operational guidance relative to aviation and energy. They're now saying that they're going to see mid to high single-digit revenue growth over the long term for GE Aerospace, and they're going to generate free cash flow that will be in line with net income. Shares up 2.6%, and since the beginning of December, this stock up more than 25%. The S&P 500 down, so really outperforming. Now, speaking of down, Silvergate, well, it is absolutely plunging again now, almost down 100% from its peak. This, if you can believe it, was a more than $200 stock just a little while ago, but one of crypto meltdown's big first casualties among the mainstream banks. This is not entirely surprising, but the company has said that they're going to be winding down and returning all deposits. They did warn of going concern risk last week. That actually appeared to weigh on banks last week, but right now we have Bitcoin down just a little bit. Let's watch the financials on the day, but seems relatively isolated to Silvergate.
Abby, thanks for that. A story for the opening bell as well, about 15 minutes away. Coming up on this program, President Biden unveiling his new budget.
The president wants to lay out in a transparent way to the American people how he sees us moving forward. And the president's going to go to Philly to speak to that.
That conversation up next.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Center.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
It isn't that the debt today is unsustainable, it's that the path is unsustainable. This only winds up one way, and that is with Congress raising the debt ceiling. No one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default. There are no rabbits to be pulled out of hats here.
President Biden preparing to reveal his budget proposal amid a looming debt ceiling standoff.
The president budget will cut the deficit by nearly $3 trillion over the next 10 years. That's nearly a $6 trillion difference between the president's budget and congressional Republicans' agenda, which would add $3 trillion to the debt.
The president expected to defy GOP calls for deeper spending cuts, proposing a series of new taxes instead, targeted at large corporations and wealthy Americans. Speaker McCarthy shooting down the prospect immediately.
You can always find common ground, your willingness to do that. I have not seen his budget. I do not believe that raising taxes is the answer. I've had this discussion with the president personally.
Let's get to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Well, you can think of today's budget unveiling from the Biden administration really as a wish list for the Democratic Party. These are provisions and ideas. We've heard them before. The Biden administration campaigned on them, and they also were discussed when they had control of the Senate and the House. So things you're going to hear about is raising taxes on billionaires. They want to increase taxes when it comes to capital gains. They want to go after provisions that help, say, the oil company or private equity or venture capitalists. But again, as Greg Vallier put it, this is really all aspirational. But it's important. You might think, why do it then? Because what this administration is trying to show is that they have a distinctive plan that is different from the Republicans when it comes to the fiscal health of the future of the U.S. economy, especially as they're about to go into a really brutal battle when it comes to raising the debt ceiling. And then second, of course, this is really, you can envision it as a campaign event. The president is widely expected to announce a re-campaign for 2024 bid, and he's showing the Americans is what he wants to do, and it polls well.
Polls very well, as we know, particularly some of these issues. AMH down in D.C. Anne-Marie, thank you. We'll catch up with Anne-Marie a little bit later. You'll hear from the president, no doubt, a little bit later as well. Dead on arrival was just a phrase that was put in almost every single headline I saw associated with this address. But to Anne-Marie's point, really laying the foundations for a run for 2024 and a second term for the president. Futures right now up 0.25% in the bond market. Things are calm. For once, your two-year, your yield is much lower by 8 basis points, 4.99 on a two-year. Lindsay Rosner, later this year, we'll be talking about a debt ceiling debate. And I think we've all asked this question a few times. Is this time different? And if it's not different, does that concern you about how far they might push it in Washington?
Well, the piece of it that I'd be concerned about if it's not different is if we don't figure out a way to deal with it. Historically, as you're aware, we've always found a way. I think the Biden plan, what we know of it so far at least, you can think about it as that's the opening hit in the tennis match. We're going to have a lot of back and forth between now and then to figure out the debt ceiling and how to make it work. My hope, because it's important for markets and stability in the U.S. going forward, is we figure it out, and I think we will.
Chair Powell says no rabbits coming out of the hat. Colin, what does all this mean to you? How do you see this playing out in the next 6 months?
Well, probably more 6 months as opposed to near term. It looks like we'll see a lot of squabbling between now and that date when the extraordinary measures expire. Our hope is that there is some sort of plan to kind of take the uncertainty out of the equation, but given kind of the bipartisan nature or partisan nature in Congress right now, that doesn't really seem likely right now. So as we get closer to the date, we think we'll see a repeat of probably what we saw in 2011. If there is a growing risk that they can't come to some sort of deal, you'll probably see Treasury bill prices of bills maturing around that date fall a little bit, because no one wants to be holding a bill whose prepayment will be deferred. So I think that's the big risk. We'd likely see risk assets fall pretty sharply. We saw that again in 2011, and we probably see long-term Treasury yields fall and their prices rise in a flight to quality bid. But again, I think we're a long ways from there because just the nature of politics today, it looks like they'll keep kicking the can until we get closer to the date that those extraordinary measures are expiring.
But Colin, that was the money question. You mentioned it. Sure, you'll get that kink in the T-bill curve. Everyone expects that. Fine. It's what you do further out. Lindsay, if it hits the fan, inflation's still elevated. Am I buying the 10-year when things get dicey?
Yeah, I think that's probably a better place to be. If you think about right now what's happened with the 2-year, a lot of people have sought safety in the 2-year part of the curve, right? Well, what's happened so far year to date is the 2-year yield has just gone up, maybe with an exception for a little bit this morning, but it's really been one direction. So your price is down, your yield is up, and people were sitting there safely in the 2-year point of the curve thinking that they would just be able to wait there until they found better opportunities. Well, your waiting has actually cost you. So I think that idea of moving out the curve where you're actually getting a real rate makes more sense. But certainly the whole question, if there's a U.S. default, makes it more challenging.
Lindsay, great to get your views on that. Lindsay Reisner there, Colin Martin on fixed income markets going into payrolls tomorrow morning. Good morning to you. Up next, your morning calls, and later, the case for cash and value with Bank of America's Jared Woodard. That conversation just around the corner. Your opening bell, 7 minutes away.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Minutes away from the opening bell. Equity futures just about positive, up 0.2% on the S&P. Let's get you some morning calls briefly. Your first call from Jefferies, downgrading Etsy to underperform from buy. Warning shares could fall by 25% as consumers cut back on spending. That stock's down 4.5%. Barclays upgrading Hilton to overweight, 168 price target, noting the company's underappreciated growth prospects. And Citi raising its FedEx price target up to 250, seeing potential upside to Q4 results next week. We're positive there, about 0.25%. Up next, Bank of America's Jared Woodard looking for opportunities in high quality and smaller value stocks. That conversation up next, your opening bell, just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Live from New York this morning. Good morning to you. About 20 seconds away from the opening bell, with equity futures just about positive, up 0.2% on the S&P. On the Nasdaq, up a little more than 0.1%. You can thank the jobless claims report for these gains. Claims coming in just a little bit softer, higher than expected. That pushes equities up and yields lower. Your opening bell in New York rings, switch at the board and get to the bond market. Yields look a little something like this. They're lower by a couple of basis points to 396.78, much lower at the front end of the curve. Your two-year yield had been climbing for 3 straight sessions until this morning. Your two-year is lower, yields down by almost 9 basis points now, 498 after going through 5% the other way. We dropped back below 5% this way. So let's call it 498 or maybe even 499. So yields come in, jobless claims soft, payrolls tomorrow, going into payrolls, 105.73 on euro dollar, slightly stronger euro, up 0.25%. Fascinating spat on the ECB Governing Council. The Austrian Central Bank Governor said he wants 4 more 50 basis point hikes, potentially. And then I think the Italian Central Bank Governor came out this morning and said he does not appreciate committing to future conversations at future meetings. So the Governing Council later this month is going to be spicy. Euro dollar just south of 106, crude 77.40 on WTI. We're positive there, 0.9%. Almost a minute into the session, equities positive 0.2 on the S&P. The Nasdaq did lead yesterday, lags a little bit today, up 0.1% on the Nasdaq. One stock to watch at the open, JD.com. Shares under pressure after growth of first-party sales fell short of estimates, with lockdowns weighing on consumer spending. JD.com down 6%, Abby.
Yeah, pretty brutal day and a 6-down day in a row, the worst losing streak since July of last year. And it's interesting, John, because they put up a fourth quarter that on the surface looks okay. They actually beat adjusted earnings in a big way. Revenue's basically in line, but beneath the surface, less so. Now, the sales from their first-party sales in the fourth quarter missing the mark, so investors not liking that. And in addition, COVID disruptions hitting sales of electronics and appliance categories. The EBITDA and earnings blew past estimates amid the cost-cutting efforts. So again, mixed results here for JD.com. Now, one positive, they did announce a cash dividend, but not enough for investors at this point. Relative to sales overall, while they grew 7% and were basically in line on the surface, they're moving in the wrong direction. Back in 2015, sales were growing year over year by more than 60%, so 7% now on these COVID disruptions seems relatively low. And on the year, JD.com is one of the China tech companies that is underperforming. Overall, the NASDAQ Golden Dragon Index up about 4%. JD.com, though, down 23%. And again, they are paying out a cash dividend of 31 cents sometime around early May. A lot of analysts saying that this shows their confidence in profitability and cash generation. Investors really not caring today, again, with that stock. JD.com down about 6%.
Abby, thanks for that. Just to keep you up to speed on Silvergate Capital, we talked about them a little bit earlier this morning. At the opening bow, down almost 40%, negative about 39% right now on Silvergate. On the plan, of course, to wind down the bank, that stock is getting absolutely hammered. Also watching Uber as well. The company said to be considering a spin-off of its freight logistics unit. This after the CFO highlighted the challenges going forward due to the cyclical downturn in the business. Katie Lyons has more. Hey, Katie.
Hey, John. Yeah, for context here, this operates as an independent unit. It essentially matches trucking companies with those that are looking to transport loads. And obviously, given a downturn in trucking, it is a business that is struggling. And now, from Bloomberg's reporting, we understand it may be spun off either via a sale or as a separation out into a separate publicly traded company. An IPO, from our understanding, seen as a more likely option. And while Uber is discussing its options with potential advisors, we understand that no decision necessarily is imminent at this time. But still, though, you're seeing the stock up the better part of 1% in the first few minutes of trading this morning. Why would Uber do this? Well, to streamline its focus on its other businesses, ride hailing and food delivery, which do represent the bulk of its revenue, nearly 80% relative to just the 22% of revenue that it comes from freight. And again, that is a business that has been lagging while those other businesses are growing. And it is Uber's diversification that has helped it from a performance perspective. For context, John, relative to its peer Lyft, Uber's up about 38% year to date. Lyft is down 11%, and that outperformance has really been continuing for years. The sell side also really positive on what potentially could happen to the stock if indeed we do get this freight spinoff. Our analyst here at Bloomberg Intelligence thinks it will help Uber from a cash flow perspective. And Piper Sandler actually saying when you couple this potential move with New York City changing its outlines for what gig workers are going to have to make by 2025, that could mean that Uber actually might get added to the S&P 500.
Interesting. Katie, thanks for that. Well, I've got that note from Piper Sandler in front of me on the possible spin-off. So let's build on that a little bit. Just an extra flavor from the analyst community this morning. They say this: we think divesting Uber Freight would be a good idea. There's some theoretical advantages to running a digital freight platform alongside Uber's better-known delivery segments, but in general, we think the freight business makes more sense as a standalone entity. That from Piper Sandler a little bit earlier this morning. That stock is up, of course, Uber by about 0.9%. Let's stick on tech. Tesla, among the biggest laggards this morning, as Wall Street puts a 50 basis point rate hike back on the table. The EV maker faces yet another investigation from regulators on a potential defect. Ed Ludlow has the story. Morning, Ed.
Yeah, good morning, Jonathan. Literally in the last 30 seconds, we've completely turned the corner on tech. Tesla now higher, actually, by around 0.2%. It is heading, though, for its worst week of the year so far, or matching its worst week of the year so far. NHTSA and regulators are looking at an issue that affects a very, very small, less than 0.02% of all vehicles out there, on the steering wheel potentially falling off. I'm not so sure that's having an effect on the stock this morning. The narrative around rates has really kind of been the talking point of the week so far. It's impacted not just higher multiple stocks in the software space, but also the mega caps. I remind myself this morning, looking on the Bloomberg terminal, that Tesla in particular is a stock that trades at 45 times forward earnings. And you have to keep reminding yourself of that, John, because of the news flow around it. We're now up 0.5 percentage point on Tesla. That chart's really interesting because there are a number of analysts that have added buy calls on the stock in recent weeks, particularly following that investor day, March 1st. I would also point out that's not universal. A number of analysts have also cut their price targets on the stock as well. There's a note from Morgan Stanley this morning to wrap this up, John, saying Cybertruck in particular is a sideshow, quote, and could be a lower volume or sort of lesser bought products going forward. So a lot to digest, but right now, Fed. What I think is really interesting year to date, look at that 2-year and short-term rates.
I know.
But look at the performance. Unbelievable.
It's unbelievable. To see that move in a 2-year and the outperformance of some of these tech names has just been phenomenal to see. Very unexpected. Ed, thanks for that. Thank you very much. Not the story this morning, but certainly the story of the year so far. The S&P 500 up 1/3%. The NASDAQ just about being outpaced by the S&P 500 today. It's up by almost 1/3%. Jared Woodard of Bank of America has this to say. He says, go beyond the benchmarks. Falling goods prices suggest owning deflation assets like growth stocks and bonds, but impressive strength in jobs and consumption hint at a second inflation surge, favoring value, resources, and cash. Let's make sense of this. Jared, I'm pleased to say, joined us right now. So, Jared, let's start in the obvious place. Off the back of the work that Ed Ludlow just did for us, you've got this big move in two-year yields and this outperformance in the NASDAQ. Saw it again yesterday, on a session yesterday, Jared. Why is that happening?
Well, John, I'm glad to be with you, and thanks for having me. I think that the move that you're seeing in markets this year is one in which investors realize that the deflation story and the related assets that worked so well immediately after COVID, the inflation story and the related assets that worked so well last year are both a little bit more fraught and a little bit more confusing, and so it's a year not for inflation or deflation, but for diversification. The challenge that we find, John, when we look at the longer run history of assets over the past several decades is that diversification is a lot more difficult now than it used to be. This is the 30-year anniversary of the creation of the ETF, which we cover, and I can tell you that when the first ETF launched in 1993, the average correlation among the stocks in the S&P 500 to each other was around 10%. Today, the average correlation among the stocks in the S&P 500 to each other often approaches 50%. In a crisis, as you well know, it can go much higher. So buying the equity index was a great way to diversify your portfolio 30 years ago. Today, everything increasingly looks like all one trade. And it's not just true for the S&P, John, it's true across every asset class, every sector, every region of the world.
Jared, when you screen for uncorrelated diversification in the environment we're currently in, and you can describe that environment for us as well, because I'm getting a little bit lost so far year to date because it switches from one month to the next. Where do you find that diversification now?
Well, I mean, our first piece of advice to investors is not to get shaken out this year of the inflation hedges that you built into a portfolio last year to become a bit more robust against what sure looks like structurally higher interest rates and inflation and wages and other kinds of cost pressures. If that's your view of the macro world, it's our view, then you need to have a portfolio that's more robust to those kinds of threats, something that most investors in, say, a 60-40 conventional portfolio have not had to think about for a long time. So I think, number one, don't get shaken out on the inflation side. Number two, it's very likely that we see a recession in the United States this year, and so there will be a moment, probably multiple moments, in which the deflation beneficiaries, especially tech stocks, government bonds, enjoy short-term tactical rallies. For investors who want to take advantage of those, I think it's fine to be aware of those and to move accordingly. But the main thing to do, I think, for the broadest swath of investors is to look for places that are less correlated. I can tell you it's not European equities, which have gone from 30% to 90% correlated to the U.S. It's not even high-yield bonds, which have gone from 30% to 80% correlated to stocks. It's going beneath the big benchmarks, beneath headline regions. It's a bit more difficult, although with ETFs and other products, you can be a bit more nimble today, no matter who you are, than ever before. One metric we do like is free cash flow yield as a measure of quality. That's been a fantastic performer and a way to navigate trends that focuses on the real underlying fundamentals in a business and isn't so dominated by interest rate exposure or macro stories or other kinds of things. Within regions of the world, we like emerging markets ex-China as a place to capture strong productivity, strong growth potential without some of the risks that are very obvious to investors these days around investing in China or in some other parts of international equities. I would say, John, lastly, most investors still haven't made big changes. And one thing that we're watching, I think it's very important for a major market low, is outflows from household active investors. You've seen that around all the major turning points. After the dot-com bubble burst, after the great financial crisis, these turning points in markets were always marked by big outflows from household investors, and we never saw that last year, despite the bear market. We haven't seen it this year. I think once investors understand that cash is attractive, maybe credit is attractive, equity earnings are pressured, equity price returns look less likely, you'll likely see those outflows this year, and I think that'll get you on your way to a more sustainable bottom in this market.
And Jared, a conversation I've had with a couple of investors already so far this morning, they've just offered the reasons why they like credit over equity. And the reasons they like credit are pretty clear. They believe that companies, corporate executives will be forced to make decisions because of high interest rates that benefit credit holders over equity holders. Now, you've made the point, and this stands out for me in terms of your calls. Within high yield, you like fallen angels. So for people who don't follow the credit market, that means you drop from investment grade down towards high yield to junk status. Jared, why do you like those names?
I like those names, John, because fallen angel corporate bonds, these are recently downgraded with some potential to be upgraded, have been fantastic performers across the full market cycle. In fact, when we look at risk-adjusted returns across maturities and across credit ratings, those fallen angel, highest quality, high yield bonds have historically been some of the best performers on a risk-adjusted basis over a cycle. It's absolutely true. Those are still somewhat cyclical businesses. They've been downgraded for some reason. But the reason I think that that particular category has done so well is that they benefit from the kind of mispricing and the liquidity that shifts when you're downgraded from investment grade to high yield. There's some forced selling that happens, and historically, those companies have often been able to repair themselves, get upgraded again, become eligible as investment grade again, and see huge benefits. So investors who want to take advantage of that dynamic and who are able to ride through what's likely to be a meaningful recession this year, I think we'll be able to pick up some yield at really attractive prices. And I think as markets start to price in recession risk more seriously, you'll have multiple opportunities this year to add to that position.
Jared Woodard, smart. I think the difficulty there is, do you play the recovery to the recession before the recession has even started? But that's maybe a conversation for another time. Jared Woodard, thank you, sir, as always, from Bank of America on credit. Some really important points there, and not the first time we've heard that point so far this morning on Bloomberg TV and on Bloomberg Radio. About 14 minutes into the session, no real drama here, up a third of 1%, just kind of waiting for payrolls tomorrow morning. Coming up, big banks bracing for tougher times ahead.
We'll redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking.
That conversation up next.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
Or redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
The big banks warning of challenges ahead. Bank of America redeploying investment bankers as the deal drought continues. This coming as Citigroup forecasts a drop in trading revenue.
We are likely to see a mild recession, likely in the back half of the year. It's likely that we do see rates come in higher than we were expecting when we ended the year. We think that's likely to have an impact on GDP and result in a mild recession.
Our chief Wall Street correspondent joins us right now. Morning, Shonali.
Morning, John. Listen, usually higher interest rates are a very good thing for banks, but in this instance, they were supposed to start stabilizing by the middle of this year, according to Wall Street's expectations. With those expectations thrown out the window, you have a big stifling of not only deal activity, but that boon that the big banks got from trading has also started to diminish. So that conversation with Mark Mason over at Citigroup, he talked about the pipeline being under the surface, this pent-up demand to do things among corporations and among the buy side. But listen, at the same time, with all of that uncertainty, it's hard for those things to come to fruition anytime this year. So really, really steep drop-off here. And the longer you see these 50%, 40% drops-offs in wallet for investment banking, the harder it gets for these banks to keep people on board. Over at Bank of America, not only did they stop hiring, they also said attrition is their friend. But guess what, John? Attrition is no longer really happening all that much on Wall Street. You're seeing a lot of these banks saying people are staying on board because of lack of options elsewhere. This year is shaping up to be a tougher job market for bankers as activity remains so stifled.
There are, of course, Wall Street problems, and then there are Credit Suisse problems, and Credit Suisse wishes they had Wall Street problems, and they don't right now. Shonali, thank you. They have Credit Suisse problems. Here's another one. Delaying the publication of its annual report, sending shares lower for a fourth consecutive session, on track for its lowest close on record. The move following a last-minute query by US regulators over previous financial statements. That stock is down hard intraday and recovering just a little bit in the last couple of hours. Jan Patrick Barnett joins us right now for more. Jan Patrick, we talked about it a little bit earlier. The stock was down 5-6% at that point. It's recovered since. Can you tell me what exactly US regulators are asking?
Well, we don't know this in full detail, but the questions are about like the bank's financial statements regarding its cash flow in previous years. And as you said, this is another problem for Credit Suisse, and those problems are just piling up. And the last thing that Credit Suisse wants at this point, while it's trying to pull off a very complex restructuring and turnaround plan, is another bad headline. And you can see that in the stock today, slumping as much as 6% before recovering, as you said. It's just like the doubts are rising that the bank is really able to pull this around, and what Credit Suisse really would need at this point is some positive headlines to stabilize its stock, to stabilize the sentiment around its name, and more importantly, to avoid that more clients are pulling their money and walking out of the door, because this would then in turn, of course, increase earnings pressure in the coming quarters and make the turnaround even harder.
Not for me to say that they'll lose more clients, but they've certainly lost a big investor in the last few months. Jan Patrick, we know that David Harrow of Harris Associates sold his entire stake. How have they responded to some of that?
Well, they haven't, and that's also an issue for Credit Suisse, that the communication right now is not great. What we are seeing from the management, from the bank overall, all we get is negative headlines, very little from the bank. Of course, they stick to the turnaround plan and they want to pull this off, and maybe sometimes it's a good thing to rather stay quiet when you are in trouble. But still, at this point, Credit Suisse needs to show a little bit more of a bold move and go out there and really convince people that they're on the right track. For that, of course, first we need some numbers to improve there.
Does it get even harder to attract some of that capital from investors at a time where you're seeing this great performance elsewhere in Europe, just in terms of the stock performance?
Yeah, definitely. I mean, if you want to look for like long-term investors, you really have to convince them that the low is near and that you are able to pull off that turnaround. And there's very little evidence that the bank has given us that it's able to do so. What's more is if you talk to portfolio managers, as I did today, like 2 of them told me, like unisono, that they have very little incentive to buy the stock at this point because it's just like unpredictable what will happen, and you don't want to have a stock in your portfolio and you have to wake up every morning and check the ticker first if something else has happened. So as long as that prevails, I guess it's going to be very hard for Credit Suisse to attract fresh investors, and if they want to, it's going to be expensive as well.
The good news is that it has kind of recovered going into the close. Jan-Patrick Barnett, the bad news is it still trades at around 250, 260 over in Switzerland. Down on the year, on a year where UBS is up on the year by something like 15% the last time I checked, and the European banks on the Euro Stocks 50 index, the European banks are up like 22%. Year to date and absolutely flying. 22 minutes into the session right now, we're higher by 0.5% on the S&P, on the Nasdaq up by 0.6%. Let's get you some sector price action. Here's Abby.
Hey, John. Well, most sectors today are trading higher, led by energy up 1.5%. This, of course, as oil is up about the same amount. We also have tech higher, industrial, so strength here overall, but the financials, not so much, down about 0.8%. And a lot of this has to do with SVB Financial and the share offering, their new guidance. In fact, if we take a look at the regional banks, because we've covered the big banks pretty nicely this morning, regional banks right now basically at a 2-year low, down about 20% over the last year. SVB, a big piece of it. But you also have to wonder about the Silvergate fallout. Not a part of the index, but just that contagion fear, John.
Abby, thank you. Amazing to see a 10 basis point move at the front end of the curve. 497. That's the point in your equity market just a little bit this morning. Going into payrolls tomorrow. Your trading diary up next.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
It has been such a strange couple of days for stocks. We make this big deal about bonds and equities and how the two have this tug of war. The Nasdaq outperforms when yields are up and seemingly outperforms when yields are down as well. The Nasdaq's up 0.8%, the S&P up 0.5%. Let's get to your trading diary. Going into a little bit later, President Biden speaks this morning. We'll hear from him at 2:30 Eastern Time, speaking from Philadelphia with his budget proposal. Secretary Yellen testifying about the president's budget on Friday. Governor Kuroda's last rate decision, and finally the main event is payrolls. Payrolls and bonds are rallying, today at least. Payrolls estimate 225. From New York, this is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Could face bigger challenges. What's next?
Was going to keep rain World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It
it had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about say a kilometer across, is capable of causing very, very wide devastation across the planet, really truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. and well, space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account
than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs, in the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak